let's talk PE ratios. What is it, how to calculate it, and when is it useful? Please keep in mind that this is not financial advice and I'm not a financial planner. I may have a financial interest in the company's products or properties mentioned. So what is a PE ratio? You've got P and E. That stands for price over earnings, or when you say over, it's divided by earnings. That's what gives us the ratio. So a price of $10 over earnings of $10 is a PE of 1. Let's create a bit of an example. So let's say we own a soap business that sells soap, and it's divided into 4 shares. So you've got 1, 2, 3, 4 shares, and this soap business is listed on the stock exchange. Now, the price is the market price the market is willing to pay for one of those shares. It is not the value of that share, which is why we do valuations. So if that one share has a price of, say, $10, that's what the market is willing to pay for that share at this point in time. So you have a price of $10, and if you times that by 4, that gives us the market capitalization of the entire business of $40. Again, that is not the company's value. That's just what the market is willing to pay for that company. So if we take the price and we divide that by the earnings. So the earnings are basically the profits chopped into 4. So if we have a top line revenue of, for simplicity's sake, let's say it's $40 revenue, and we have expenses of $20. So this is, your operations, your marketing, accounting, all your expenses, cost of goods sold. So, the ingredients to make the soap. We end up with a profit for the company of $20. So you take that $20 and you divide that by 4. So you've got $5. And that's our earnings for the year. So you've got a price of 10 and earnings of 5. So $10 as the price divided by $5. This gives us a PE. This is supposed to be an equals. That gives us a PE of 10 divided by 5 is 2. That gives us a PE of 2. If the market price goes up, say, we're expecting higher growth in the soap business and people are willing to pay $20 for our soap business shares. Again, this will you times this by 4 and you get the market cap, which is the overall market price. But again, this is the price per share. You get our $20 price and you divide that by our $5, and that gives you a PE of 20 divided by 5 is 4, so PE of 4. So you've got, what was it? It was a $20 share price and $5 earnings. There was a PE of 4, so it'd take 4 years of $5 to make price, because 4 times 5 is 20. So when you think about it, it'll take you 4 years to regain your investment or break even. Now, that's assuming that the E doesn't grow at all. So this could potentially go down. If say this increases to $6 or $7, the time it'll take to recoup that $20 obviously will fall. Okay, let's do a actual example. For this example, we'll just use the reported earnings. So you can see I've just selected Kogan, which is on the Australian Stock Exchange. It's the same concept whether you're in the States or any other country really. Kogan's similar to Amazon in that it's an online retailer, and it's quite big here in Australia. It's had a pretty good growth run, and you can see June 2019, it had earnings of 18 cents. So if we wanted to do a PE ratio, I'll get the calculator out because I don't want to do this in my head. So we've got $16.73 as the price. Yeah, let's get rid of this. So we've got $16.73, and we divide that by 18 cents. That gives us a PE of 92.94. So, like I said before, if we bought that share today, so we buy one share of Kogan at $16.73, and its earnings didn't grow or change from June 2019, it'd take 92.94 years to essentially make that back. It's not necessarily that you will receive that money, but the business will generate that profit. So if they pay dividends, you might get some or all of those earnings. But generally speaking, these technology companies, they'll try to retain as much of that earnings as possible to continue their growth. So I'll just run through an example with a more mature business. So I've selected the Commonwealth Bank of Australia, ASX CBA. For all those international people out there, this is a major retail bank here in Australia. $4.92 is the most recent earnings in ComSec, so we'll just use that. So $4.92. So if we grab our calculator and we divide the price, so 71.24 by the earnings, $4.92, we get a PE of 14.47. So you can see there's a major difference between Kogan and the Commonwealth Bank. We're talking 14.5 years as opposed to 90 plus years for Kogan. So when you think about a business will be introduced, it'll go through a period of growth, it'll mature, and then eventually decline. And that's a typical business life cycle. In saying that, once a business gets into the maturity phase, it can revert back to growth and continue growing and then mature later on, or it could begin to decline and then go back into growth phase, or it could grow and then decline because of competitors or some other issues. When is a good time to use the PE? PE, generally speaking, is best used for companies in the mature phase. So we can do a PE somewhat reliably based on its earnings and its current share price. For a growth business, the PE isn't exactly the best metric, and it's not really the metric I'd use. I'd be looking at top line growth, revenue growth, the total addressable market in terms of how much market could they potentially get, and how much have they got currently. Well, the same is true for discount cash flows. Obviously, you're discounting the cash. Growth companies may not necessarily have any cash or be earning any cash. This is like the Warren Buffett zone. You've got your value plays, and you've got dividend plays, or shares you're buying yield. They all kind of sit in this mature phase. Decline phase is for the turnaround. So if it's starting to decline, or they've got some sort of systemic issues, and you invest, and they manage to turn it around, that's a turnaround play. The PE is probably not really relevant for that either. I guess you could do a PE up here somewhere. Well, you can do a PE here, but the turnaround plays are a bit of a roll of the dice. You're really relying on the competence of managers and other factors to ensure that it actually turns around and recovers. Introductory phase, again, you can't really do a PE on a company that's just starting, because they've just started. Chances are they're making zero money, losing money, so there'll be no earnings. Again, you're probably better off in the introductory phase if you're investing at that level, considering the total addressable market and some qualitative factors. Who's the management? What have they done before? What is their product or service? Is it going to be viable? Who their competitors are? That type of thing. And they're the kind of things I'd look at for the intro and growth phase. Yeah, so to summarize, PE ratios, they can be useful. They're extremely easy to do, but they're not necessarily useful for companies in the growth or introductory phases, and maybe not necessarily best used for companies that are in decline and you're expecting a turnaround either. In terms of, one quick point I'll make is with that phase, in terms of, I don't want you guys to confuse intro with IPO, like the initial public offering when it's listed on the exchange. Companies that are in the mature phase could actually be listed on the stock exchange as an IPO. Companies that are in decline could be getting listed. Companies in the growth phase could be getting listed. So IPO doesn't mean that it's in the introductory phase. What I mean here is that a business is just developing its new. Thanks for watching, guys. Please like the video and subscribe if you haven't already, and I'll catch you soon.